Have you ever looked at two companies that seem almost identical on the surface, but when you check their financial reports, the stories are completely different? It can be total chaos. Well, today, we're diving into the rulebook that's designed to bring some serious clarity to that chaos. It's called Accounting Standard 1, and it's basically the guide to disclosing how companies cook their books, legally, of course.
So here's our game plan for getting from that chaos to clarity. We're going to kick things off with a little puzzle, a tale of two ledgers. Then we'll get into the 3 golden rules that are really the foundation for any accounting you can trust. After that, we'll look at how companies actually choose their own unique financial recipe, why they have to put that recipe on full display, and probably the most important part, why any of this actually matters to you.
All right, let's jump right into that puzzle. The whole reason a standard like AS1 even exists is to solve this one huge problem. How can two businesses with the exact same sales and the exact same costs end up looking totally different on paper? I mean, it sounds like it shouldn't be possible, right? But believe me, it happens all the time.
Okay, just look at this. You've got Company A reporting a profit of $1 million, and then there's Company B with $5 million. Your first thought is, wow, Company B is absolutely crushing it. But what if I told you they had the exact same year? Same sales, same costs, same everything. How on earth can both of these numbers be true?
The secret, and this is the key to our whole explainer today, is their accounting policies. The best way to think about it is like a recipe. You can give two chefs the exact same ingredients, but if they use different methods, they're going to end up with two very different dishes. Well, it's pretty much the same thing in the world of finance.
So what are these policies, really? Put simply, they're the specific principles and the methods a company chooses to use when putting together its financial statements. And that word chooses is everything. It's where all the variation comes from, and it's exactly why comparing companies can feel like comparing apples and oranges if you don't know which recipe they're following.
And this is the entire mission of Accounting Standard 1. It was created to cut right through that confusion. By making companies show their work, it gives us, the readers, a fighting chance to understand what we're really looking at. It's all about enabling a true, meaningful comparison between different businesses.
Okay, now before we dig into all the choices companies get to make, we have to talk about the bedrock. There are 3 assumptions in accounting that are so fundamental, they're just assumed. They're the non-negotiables. Think of them as the 3 golden rules.
First up, we have going concern. This is the basic belief that the company isn't about to go belly up. When you're reading a financial report, you can just assume that the people who made it believe the business is going to be around for the foreseeable future. They're not planning on packing it all in and shutting down tomorrow.
Second is consistency. Now this one is a really big deal. It basically stops companies from switching up their accounting methods every single year just to make their profits look a little better. You have to assume they're using the same recipe this year that they used last year. Without this rule, trying to compare performance over time would be completely useless.
And our third golden rule is accrual. This one can seem a little technical, but it is absolutely crucial. All it means is that a company records its revenue the moment it's earned, not just when the cash finally shows up in the bank. And on the flip side, expenses are recorded when they happen, not just when the bill gets paid. It gives you a much more accurate picture of how a company actually performed during a specific time.
So here's the kicker. These 3 assumptions, going concern, consistency, and accrual, they're the default setting. A company doesn't need to waste ink writing, "Hey, just so you know, we plan to stay in business." It's just assumed. They only have to call it out and make a special disclosure if, for some very unusual reason, they're not following one of these fundamental rules.
Okay, so if those 3 rules are basically set in stone, where does all that variation we talked about come from? Well, this next part is all about the recipe itself, the areas where companies actually do have choices, and the guidelines they're supposed to follow when making them.
And this just gives you a little taste of how many choices there really are. For instance, how does a company account for a big piece of machinery getting older and less valuable? That's a policy on depreciation. How do they figure out the value of all the products just sitting in their warehouse? That's inventory valuation. And for every one of these areas, there are multiple, perfectly legal methods a company can choose from.
So how do you pick the right one? Well, the standard gives a framework based on 3 big ideas. First is prudence, which is just a fancy way of saying don't count your chickens before they hatch. Recognize potential losses, but don't get ahead of yourself and recognize profits that aren't certain. Second, substance over form. You have to account for what a transaction really is, its economic reality, not just what the legal paperwork says. And third is materiality. You have to disclose anything that's big enough to actually influence someone's decision.
But at the end of the day, all of these choices, all of these considerations, they have to serve one primary goal: making sure the financial statements present a true and fair view of the company's financial health. That right there is the North Star for every single one of these policy decisions.
This brings us to the absolute heart of Accounting Standard 1. So, we know companies have choices and we know how they're supposed to make them. But how does any of that help us, the people reading the reports? Well, this is where the single most important rule of the whole standard comes into play: mandatory disclosure.
And there it is. This one sentence is the main event. All significant accounting policies should be disclosed. This is the core principle of transparency. It says, look, you can pick your recipe, that's fine, but you have to print that recipe right there in the menu for everyone to see. No exceptions.
And the standard is super specific about how this has to be done. The disclosures have to be an official part of the financial statements themselves, not hidden in some footnote on another website. They should all be in one place so they're easy to find. And, this is a big one, if a company does change a policy, it has to announce it, explain why, and show what the financial impact of that change was. No hiding the ball.
So we've walked through the rules, the principles, the whole shebang. But let's just zoom out for a second and bring this back to the real world. Why does any of this matter so much? Well, it's all about turning what could be really confusing data into information you can actually use to make smart, informed decisions.
This slide pretty much sums up the whole journey, right? Before this kind of standard was in place, financial reporting was a wild west. It could be confusing, totally inconsistent, and it made comparing companies almost impossible. After AS1, things are so much clearer. By forcing companies to show their work, it finally allows for that meaningful comparison we talked about right at the start.
And you have to remember, this isn't some new rule. This standard was first issued way back in 1979. It was a landmark moment that really laid the foundation for decades of financial transparency, and it helped build the trust that we all place in our financial markets today. It is truly a cornerstone of modern reporting.
And if there's one thing to take away from all this, it's this: disclosure isn't just some boring compliance task for companies. It's a tool that empowers you. It gives you the context, it gives you the recipe, so you can properly appreciate the real story the numbers are trying to tell. It puts the power back where it belongs, in the hands of the person reading the report.
So, we've established it. Companies have to publish their financial recipe for everyone to see. But that leaves us with one last and really crucial question to think about. Who makes sure the company actually followed the recipe they published? And for that matter, who checks to see if that recipe was any good in the first place? Well, that's a story for another time.